Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Well, with the Q1 reporting season pretty much in the rearview mirror now, we thought it'd be a good time to sit down with our research director, Shiraz Mian, kind of put it all in perspective for us. So Shiraz, kind of a weak first quarter reporting season, kind of dim. Where did that weakness come from?
I would say not kind of, really weak earnings season, and the reasons were many. And we had a pretty good sense in the run-up to the start of the earnings season that this would be a very weak earnings season. So a host of reasons. Q1, the U.S. economy wasn't doing too great either. And then on top of that, you had the dollar strength relative to the trading partners. And as you know, a big chunk of the large cap earnings particularly come from beyond the U.S. borders. So the strong dollar had a big bearing on earnings in general. And then on top of that, the oil sector, which is a big contributor to the S&P 500 as a whole, was a big drag on the earnings picture too. So growth issues, U.S. global, the foreign exchange issues, energy, there was no shortage of excuses and culprits.
But if we wanted to take a look at one positive for the Q1 season, even though it was a dim one, there were many domestic companies that posted high single-digit growth, right?
That's right. Yeah, and that goes back to the reasons we cited, in which we looked at the strong dollar as one of the reasons for the Q1 weakness. And absolutely, companies that did not have that foreign currency translation issue, they did better than the multinational ones. In fact, beyond the growth number that you rightly point out, there is the top line surprises were unusually weak. So companies were missing revenue estimates at a ratio that we haven't seen in the recent past. That's particularly the case for the S&P 500. The weakness was there in the small cap space as well. So more companies, even in the small cap indexes, like in the Russell 2000, S&P 600, were missing revenue estimates, but the extent of the negative comparisons to other periods was not as pronounced for the small cap as it was for the S&P 500 or the large cap stocks. So yes, domestic oriented companies that did not have as much exposure to the dollar strength issue did relatively better.
All right, so give us the bottom line on growth, revenues, and margins.
So I have this summary picture that I like to call it, and what it does is it shows the performance for Q1 relative to the performance for what we saw from the S&P 500 companies in the preceding quarter, which was the fourth quarter of 2014. We have that for earnings, for revenue, and as well as for margins. So as you could see, 2.3% total earnings growth for the S&P 500 in Q1 on 3.2% lower revenues. So revenues in the aggregate were down, and you were able to achieve that modest earnings growth based on some gains in margins. So an overall a flattish kind of earnings backdrop in an unusually weak revenue situation. And in this summary chart that I show here to folks, it shows all the 16 sectors. And just to put these numbers in context, I compare the Q1 performance for earnings and revenue with what we had seen from these companies in the preceding quarter as well as the 4-quarter average. So you could see here that the growth rates, revenue and earnings, and the beat ratios, surprises, are particularly weak relative to other recent periods. The top line particularly stands out, both in terms of growth rates as well as surprises.
All right, so we're ending the Q1 season with the typical parade of retail reports. Sector got off to a decent start, I guess you'd say, but that momentum has tailed off, hasn't it?
That's right. Yeah, we made a good start in the retail sector earnings. In fact, up to the halfway mark for the sector, particularly in the large cap in the S&P 500 index. When I would look at the results that we saw from the first half of the retail sector results, and I would compare that to what we had seen from that same 50% of the companies in the preceding quarters, we were tracking a lot better. There was no question that growth rates and surprises were better than what we had seen from these companies in prior reporting cycles. But you rightly pointed out the momentum could not be sustained. And my sense is that the earlier sample was more heavily weighted towards parts of the retail space that are in better position. So you had the online vendors, so you have the Pricelines and the eBays and the Amazon.coms of the world doing a lot better. And also we have the restaurant space in the retail, and the restaurants are doing a lot better as well. In the second half, we got into the big box retailers and we got into the department stores, so it's the Walmarts and the Macy's. They're disappointed. And we did have some positive numbers from the big box too. Best Buy did good, Target did good, Home Depot did good. But overall, the later flow of earnings was on the weak side. So net, retail still did better than most other sectors, but it's not as good as we thought it'll turn out to be.
So that tail off in momentum, is that a cause of concern as far as future consumer spending going through the second half of the year here?
I think that is the big reason. So we do see that the second quarter hoped for recovery in the economy is not showing up in consumer and business spending data. So retail sales, even the monthly government data on retail sales is coming up soft. So yes, there is the issue of consumer spending being under pressure. And then on top of that, these big box retailers are facing some secular issues too. They're facing a lot more competition from the online vendors, and there are competitive issues in the retail space itself. So yes, a combination of problems in the consumer economy and then secular issues for the space are what we are seeing seeing in the numbers as well.
Let's take a little bit of a peek into Q2 here as far as what you're expecting to see in Q2. We're talking here on May the 26th. You wrote in your earnings preview this morning that Q2 estimates are already falling. Does that mean we have another dim earnings season to look forward to?
I think so, yeah. I think it's going to be another weak earnings season, but hopefully not as weak as we saw. Let me share this slide with folks. It shows the evolution of estimates for Q2, and as you could say, we started off the year with a positive earnings growth estimate for Q2 in early January, but that has dropped to a decline of 6.7% as we speak today. So yes, the estimates have been coming down for Q2, but that's not unusual. We have been seeing that for a long time. For more than 2 years now, estimates come down like that. So this shows that the weakness we saw in Q1 will continue into Q2 as well. If there's anything positive from this otherwise grim picture, I would say that the magnitude of revisions for Q2 are not as big as we had seen in a comparable period for Q1. So yes, they are down, but not down as big as they were in the last quarter.
All right, we're going to check back with you probably in about a month to get a more concrete look at what you see happening for Q2. In the meantime, don't forget any earnings previews, earnings trends, commentaries that Shiraz wants to use to mark any shift in what's going on with the overall earnings picture can be accessed off our homepage, Zacks.com. And you can also go to Zacks.com for his daily Ahead of Wall Street column, where he talks about a little bit more than just earnings. He talks about the economy and the market and market drivers. All very interesting reading. With Shiraz, I'm Terry Ruffalo.